Hey guys, welcome to another episode of the Real CFO Podcast. Today, I'm super excited because we're going to drop some uh, information for you to take advantage of. This information is going to be money saving information. It's things you can do now before the end of the year to save on taxes. So I know a lot of you that are listening probably fall into this bucket like a lot of our clients do. And that is we wait until it's time to file our taxes before that deadline. And it's too late to enact a lot of these strategies and tools. And really, just like anything else, if you take slow, steady progress, it's easy. But if we wait till the last minute, procrastinate, like most of us do on several things that are uncomfortable, we don't like to do, it's not our niche, right? It becomes stressful. It increases anxiety. So, it's very important for you to take a minute, listen to this episode, draw from it some information that you can do, and then reach out to your CPA, accountant, reach out to me, somebody that you trust in financial matters, and discuss these opportunities with them and see if they are valid for you. So, here's the thing. If you wait until March to think about these taxes for 2025, you're going to be lost. You're going to miss deductions. Um, and it's going to create anxiety, stress. You're going to spend more money than you would have normally had to. You're not going to get much value from that CPA or that accountant that's doing the work for you because they're simply taking what you give them, plugging it into a form, and there's really no proactive strategy. So just remember this: urgency with intentionality. We've had clients that have come to us and we've been able to save them thousands, tens of thousands, hundreds of thousands of dollars here in the last month of the year simply by doing some effective things. So here's the deal. We know as business owners, we're busy doing our stuff. Holidays, we just got through Thanksgiving. Christmas is coming up. There's expectations on our time, requirements for our time from family to our community, to our business. Everything is drawing energy from us. So now in this week, the next 2 weeks before you get into kind of the lull before Christmas and through Christmas and New Year's, the first 2 weeks of December are significant, right? So I know you're in the weeds, you're doing your business, you're operating it. Now it's time to put in a few extra hours and pull back and put some of this information together. So you hustle so hard, but tax planning, it really isn't about working harder. It's about working proactively earlier and doing the simple things. So most people don't know that they should be what they should be tracking or what they should be asking. Okay, so you can't maximize, just like in your business, you can't maximize your return on your investment. You can't maximize your tax mitigation if you don't measure it. So here's a few steps that we're going to go over that I think you need to do here in the next couple of weeks. And again, if you have any questions, reach out to your CPA, reach out to your accountant, somebody you trust with financial matters, or reach out to us directly. But here's step one: clean, accurate books are the foundation to tax planning. So try to reconcile all of your 2025 accounts. That way, all of your information is in there, at least through November. Properly categorize your expenses, contract labor, payroll, meals and entertainment, repairs, those sorts of things, or have your bookkeeper do it. If you want a second set of eyes to look at the books to make sure your bookkeeper's doing a good job, or you are, I'd be happy to jump on a 15-minute call and go over that with you, or somebody on my team would. But those are the things that need to start happening this week. So key piece of advice especially for the new business owners, we run into this all the time: stop running personal expenses through your business. It makes planning very, very hard. In fact, we've had instances where a lot of this information that folks were categorizing in their books, granted, we weren't their bookkeeper, we weren't their accountant, they would categorize a lot of personal expenses as business expenses. And when that's automatically done in QuickBooks or whatever, you set up rules so everything is automatically put in, it can increase your expenses. right? Which if you do that and it come tax time, we actually look at it and you have to take some of those personal out. Now you're not able to accurately plan at the end of the year because you might have $50,000 of personal expenses in there. So separate your personal expenses from your business expenses. That's a key thing. Make sure that you have all of your balance sheet accounts. That's your assets, your liabilities, and your equity. Um, Make sure your bank accounts are reconciled, right? The balances tie out. Your loan balances are tied out. Interest is properly accounted for. Your credit card transactions are properly categorized, and your credit cards are properly reconciled in your uh, balance sheet. Inventory, if you track inventory, make sure you do a year-end inventory so you know what that inventory is. And then shareholder distributions, owner compensation, that is a significant one. So many times we see companies that have elected, say, S Corp status, and now they're taking excess distributions above and beyond the profit of the business. Maybe they're using the credit card for personal expenses. Maybe they've got a SBA loan or some sort of loan or line of credit, and they're taking distributions in excess of their equity. That's going to cost you come tax time because you're going to have tax on those excess distributions. That is a huge thing that a lot of business owners, and in fact, CPAs and strategists don't look at, is distributions, what shareholder equity is. And so good tax planning really can't be done unless the balance sheet is fully reconciled. And the reason that is, if we can reconcile the balance sheet, we know everything in the P&L is recorded. It might not be in the right bucket, but at least it's recorded, and we can take from totals from that and do a tax analysis for you. So that was step one. Get your books in order. If you don't have it, start doing it. If you need some help, give us a holler or your trusted advisor. So step two is you need to know your 2025 tax position before December 31st, right? That way you can estimate taxable income. You can forecast what your Q4 finish is going to look like. So at the end of the year, you know what that is, and then you can estimate what your tax exposure is going to be. Once you know what that number is going to be, you can look at one, strategies, two, estimated tax payments. Making that payment by January 15th in an estimate will significantly reduce your outlay come April, and it won't be a huge surprise. If you can't pay it all, pay a chunk. But here's what happens a lot of times. Folks don't have their ducks in a row. They don't have their financial information put together. They file an extension, and then they don't file until September when the corporate returns due. October when the personal returns due and that's where most LLCs, S corporations actually pay their taxes, is on that personal tax return. It's a flow through. But let me tell you this, an extension is this. It is an extension of time to file in order to avoid a penalty for failure to file. It is not an extension of time to pay. So if you owe $15,000, $20,000 when you ultimately file your return in October, you might have $1,000, $2,000 worth of penalties because you did not pay on time. Okay, so keep that in mind. An extension is not an extension of time to pay. It's merely an extension of time to file to avoid the failure to file penalty. So step two, again, know your tax position before the end of the year so you can make estimates or you can plan. Okay. Step three, execute December only strategies. Now, here's a few. Prepay expenses, rent, utilities, marketing, insurance, software, if it makes sense. Typically, the IRS views anything that is paid in advance not longer than 12 months can be a current year expense. So if you pay those, you get the deduction in 2025. The check has to be cut and sent before January 1st. So before the end of the year, you have to do that. So if it makes sense, not saying simply diminish your cash flow and hurt your business by doing this, but if it makes sense, prepay some of those expenses. Another thing, accelerate large purchases. vehicles, equipment, tools, computers, improvements. Doing so, you can utilize the Section 179 bonus depreciation where you can, and it can be a huge tax savings. I've seen people wipe out 100% of their taxable income simply by doing it. Now, this doesn't mean to go out and buy a $150,000 truck for your business. That one, we could question whether you use it 100% for business, or two, that you don't need, right? If that vehicle, that $150,000 vehicle, $100,000 vehicle is not providing a return on asset, meaning you're not able to, you're just buying it. You're not buying it to put go from 2 crews to 3 crews or 4 crews to 5 crews. If you're doing that, that's great because they need vehicles. But if you're just buying it simply to buy it to get tax savings and you don't need it to get a return on that investment, don't spend your business capital on it. Another one, retirement contributions, 401k, safe harbor, solos, SEPs, simples. Have a plan in place for those. Some of these have to be done by the end of the year, right? Some don't. They can be done before the tax return is filed. So keep that in mind. Look at retirement contributions, owner salary adjustments for S corps. That comes into what we talked about a little bit earlier, is distributions versus salary. Distributions reduce equity and many times create excess distributions, which in turn creates capital gains tax on that excess. Some of that can be allocated to owner salary adjustments. That way you're paying your self-employment tax, FICA, Medicare, the businesses anyway, their portion, and you are through your withholdings, and that is not considered distributions. You're going to be taxed on the wages, however, but tying it in with some retirement contributions, some planning there could help. You can look at the Augusta rule. If it's legitimate, if you have team meetings were held at your home, right, and you have an agreement, you can put an agreement in place that the business is going to reimburse you for those. Accountable plans, again, reimbursement for home office mileage, tech subscriptions, software, things like that, that the company can reimburse you for. Deduction for the company, not taxable to you. W-2 deadlines, you need health insurance, HSAs, fringe benefits, things like that should be considered as well. Statistics show that most people miss 20 to 40% of available deductions simply because they don't execute them before the end of the year. So don't fall into that trap. Step 4, tax strategy layering for 2026. Advanced strategies. These will require some additional planning prior for year end. You can still implement some entity structuring. If you are an LLC and you are a single member LLC and you're making more than say $60,000 in net profit, it's time for you to consider S corporation status. If you're starting a new business, it might be time to consider a C corp, depending on what your goals are for that business. You want to look at family payroll opportunities. Can you pay your spouses, kids? What does that mean? Can you stack some retirement for the spouse? Maybe get on a health reimbursement account, pay your kids, and depending on their tax situation, most likely you can pay them from the business. They don't make enough to have to pay income taxes, but the business gets the deduction. They can use that money to pay for select ball teams or, invest in their retirement, college savings plan, etc. Look at depreciation and cost setting. That's something more advanced strategy that can still be implemented now. Charitable planning. Look at donor advised funds. If you really want to leave a legacy and you have a stack of cash that you really want to donate, you're not quite sure where, you can set up a donor advised fund. You can contribute the money, get the deduction this year, maybe, and then you can direct where that money goes in future years. So there's other credits to look at: R&D, WOTC, 1790, solar credits. Those are kind of aging out that you might want to look at. Tax savings, you might not hit one and it's going to eliminate all of your tax, but they stack. So every little bit helps. And by the time you get done kind of layering some of these tax saving strategies, you'd be surprised at how much you can save. So step 5, document everything. Keep receipts, mileage logs, board minutes, accountable plan docs. If the IRS comes back and you don't have any of that documented, they're going to come back and say you underreported. There could be some penalties there. You're going to pay the additional tax, and it could get ugly. So that is, if you get audited, documentation it makes it an easy conversation. You provide it to them, and there you go. Step 6. Now, you have to build these habits into a proactive plan throughout the year. So this is a great opportunity to say, how am I going to be sort of the CFO or the leader of the financial side of my business in 2026? So implement a process where if you're not doing the books, which you shouldn't be, you should have a bookkeeper or internal person doing it, maybe a CPA or a resource on the outside that reviews and makes sure, but have monthly reconciliations, right? Reconcile those financial statements so everything is in order, in place. It might be in a different bucket, but at least it's in the books, right? If you reconcile your balance sheet. It also is a great time to have monthly or quarterly meetings with your advisor, your CPA, your tax strategist, your whoever it may be, right? So you can sit down and go over your financial statements, look at what potential tax exposure you might have, make quarterly estimated tax payments, or make some decisions to mitigate those taxes in a smart, thoughtful way. You go over monthly KPI reviews, gross profit, margins, cash flow, owner comp. Put together a budget for 2026. Okay. You can start now, but you can start at the beginning of the year and piece something together. If you're using QuickBooks, that's something that can easily be done. If you need help with that, talk to your CPA advisor or holler at us. We'd be more than happy to help. And then keep personal and business finances clean and separate, as we discussed earlier. Excuse me. So those are some of the things that I think you should do. Now it's the end of the year and planning for this year and then picking up for next year. I'd say all of this is kind of like, oh crap, I'm stuck, I'm not there. Here's what you can do. You can book a tax planning call with us. We can help you walk through some steps. You should contact your CPA or advisor that you trust and say, hey, what about these things? And do it now. And if they don't respond or don't communicate or whatever, reach out to us. We'll be happy to get on a 15, 20-minute call and give you some ideas and thoughts, and even explore helping you get your books cleaned up, review your entity structure, implement some strategies. We'd be happy to do that. But jump on a 10, 15, 20-minute call with us if your advisor is not being proactive like that. So you need to, I know it's the end of the year. We've got a couple weeks, and then Christmas kind of lull kind of sets in for most. You need to slow down. You need to delegate some of your operations to other people, and you need to focus some time and energy on this. Either delegate or add more hours to the day, right? You need to do that in the first couple of weeks of the month, because it could save you thousands of dollars when you go to file your taxes. Okay. Keep in mind, moving forward, you need to be your business's CFO. The real CFO isn't about being the one that directs and does the financial work and reconciles the books and does all this stuff, right? The real CFO is the leader of the business, but has a pulse, knows the financial pulse of the organization and is directing the ship, right? And kind of guide and say, hey, we need quarterly meetings so I understand my financials, or monthly meetings to do the same. We need to make estimated tax payments every quarter, and here are the dates to do that. We need to be able to make financial decisions because our books are clean, and I want to be able to do that when we're meeting with our advisors to go over these things. So you have to be the CFO, the one guiding it, leading it. Your bookkeeper is not going to do it. Your CPA is not going to do it. You have to do it, and you have to drive the ship. Now, it helps if your bookkeeper sees you leading in that example. They're going to know what the expectation is from you, right? They're going to know what that expectation is. So is your CPA. And if they're not proactive, they're not listening, they don't return calls a week, a month, emails, whatever it may be, or they charge you for every time that you ask a question, it might be time for you to assess where you're at with them, assess that relationship, and maybe make a change. Okay. But you are the real CFO. You have to guide this ship in the financial side of your business. For most small business owners anyway, you're not going to be able to afford a $200,000 a year CFO, right? So again, real CFO, Chief Faith, Family, Fitness, and Finance Officer. We talked about finance today. Pick up the ball, start running with it, leading from a financial perspective. And leading means understanding where you're at, owning where you're at right now. And if that is, I don't have things in order, I don't have things, it's your role as the CFO of your business to reach out to your advisors, your bookkeepers, or find somebody new that can help you get a firm foundation regarding your financials. It'll save you thousands of dollars in the long run. Just like any other dollar invested, you should be getting a return on that investment from your advisor. So I hope this helps you guys out there. I know when I was a small business owner, there was a lot of things I thought I knew and I needed help with, but I was so focused and driven on what I was doing that I forgot some of these things. So it's common. 99% of us do it when we start in business. About 50% of us come out and actually implement strategies and plans to keep an eye on the pulse of our financial situation in the business rather than waiting to the end of the year. Hope this helps you guys. If you know somebody that needs to hear this, please share it. Tell your friends about us. Tell them to sign up. You can go over to YouTube, The Real CFO Project, subscribe to our channel. We appreciate any likes, follows, anything you can do to get the word out. We'll see you next time.